Dan, I'll begin with you. I saw within your notes you have a 335 target on Apple, and you said they ripped the Band-Aid off. Dan, what does that mean? What should we be looking for Apple?
Look, I think ultimately, I mean, all the sort of bad news everyone was fearing was better than expected. I mean, if you look, they're in the eye of the storm in the supply chain as well as on the demand side. No guidance for June, but I think what the stock's baking in is something right now that's on the other side of the dark valley. That's what investors are focused on, what that sort of cycle looks like into December and into 2021. And the big thing, services. I mean, services is sort of the bedrock that's keeping the stock and the valuation, I think ultimately firmer here than it would be. So I think net, you combine that with China, which is showing some rebound, better than feared. It speaks to Apple, what I believe is a stock trending back toward over 300.
Are you, Dan, just quickly, are you thinking about Apple's plans to raise the funds and the notes offering that they're talking about? I know they have a new 13-inch MacBook, but as they're raising these funds, is that troubling to you or no big deal?
Yeah, I view that as just typical corporate governance, what they're doing. I think the big thing now was the buyback. Remember, I mean, many thought they would actually pause the buyback given some of the pressures. Instead, they actually upped it 50 billion. So I think that was another feather in the cap for the bulls.
Sure. Frank, we were just talking about the buybacks. Dan's mentioning Apple's buyback. Sarah Roback, who just did an in-depth report on Skyworks, which obviously an Apple supplier, we're waiting for after the bell. They gave some guidance that was weaker, but then they said their revenue looked like it was above the midpoint. And there's talk that they might even, up the buybacks. So what are your thoughts here, Frank, on Apple, some of the suppliers that go with it?
I look at Apple trading at one of its most expensive valuations in the past 10 years, at 23 times forward earnings. So they're really pricing in not just a full recovery, but that conditions are going to be better off a year from now than they were pre-coronavirus, which I just don't see. So, when I'm looking at Apple, and a lot of it's tied to the consumers, and we're in one of the worst recessions since the Great Depression, and I know a lot of people believe that this is going to be more of a V-shaped recovery. With Apple at 23 times forward earnings, I think a lot's priced in considering 2018, 2019 year over year. This company actually saw its earnings and sales decline year over year. So when I look at 2020, why did it deserve that big multiple? 5G was coming out, 2020 was supposed to be awesome, and now that's not the case. So expectations are sky high for Apple. I'd rather own one of their suppliers, which that money's going to flow through earlier, like a Skyworks when they have these orders. But I mean, we're assuming that there's going to be no delays. We're assuming that their two key growth markets, which is China and Europe, are going to be fantastic. When Europe was in a recession pre-coronavirus just about, and China growth has slowed considerably. I just don't know how they're going to meet those expectations. And a $50 billion buyback, I just don't get. I don't know if I want Apple using that money to buy back that stock.
So, Frank, what's your fair price on Apple then? You don't like that it's 23 times earnings. You think it's too expensive. You think the outlook's too optimistic, Frank. Where do you think it is right now? It's trading at 290. Dan Ives has a 335 target going forward. Frank, where do you think Apple should really be trading?
Around 225, 230, so about 25% downside, I think. And it would still be trading at a premium to the market at those levels. They deserve that premium. They have a fantastic balance sheet. But again, with the buybacks, and I don't agree with them buying back the stock.
Right.
They need to buy back the stock in order to make those earnings.
Okay.
We'll see.
All right. Dan, I know Wedbush does a lot of channel checks across China and Asia, which is something that you often quote. Are you finding something to give a real substantial rebuttal to what Frank is saying? Because there are some concerns that next year won't be as good as people think.
Yeah, I think, look, what Frank's saying is there's a big contingent out there that continues to doubt Apple. Where I sort of differ is just more on the overall pent-up install base. I mean, if you look right now, 350 to 925 million have not upgraded their phones in 42 months. And that's really what you're betting on here. And it's also about the services. You can't look at it on a flat EPS, PE. I like to look at it on some of the parts. I believe the value of the services business is 500 to 600 billion. And our checks in China, even as of last week, show 165 to 185 million units for 2020 coming out of the supply chain, which if that holds, I think that's going to be enough for the stock to move higher.
All right. Now I'm going to give you guys time cues. 30 seconds, Dan Ives. Tesla, Disney, tell me anything you want.
Look, I mean, I'll start with Disney. I mean, Disney, it continues to be the streaming. I mean, I think streaming could add 20 or $30 a share. That's the key here in terms of what you're seeing. It's in Bonanza, and they've continued to be successful there. On Tesla, it was better than fear in terms of delivery. Streets looking for the other side, the dark valley. It's all about China. That's really what I view as $300 per share. That's a big part of the fundamental bull thesis here as you go to our $1,000 bull case on Tesla.
Frank, 30 seconds. Disney, Tesla, give me anything you want.
Disney, a lot going on under the hood, a lot of debt payments. They leverage themselves to get into streaming, which is one of the worst businesses in the world. It's great for you and me, but it's not really good for companies because there's no pricing power and it costs a fortune. That leaves the rest of their divisions, which are seeing significant declines. So I could see Disney at 40 times forward earnings, suspending their dividend. They just don't have enough money, $3 billion to pay that dividend, and a $7.5 billion debt payment coming up. So I'd be worried about Disney. As far as Tesla, I have a neutral rating on right now. If it has come down after Elon Musk's comments, but yeah, I wouldn't be shorting Tesla here because a lot of people got crushed shorting Tesla. But Tesla's a neutral.
Dan Ives and Frank Curzio, thank you both.